Good afternoon. George Cavaligos for HFT Bonds and Notes. We spoke about, bonds making new highs yesterday. We also need to talk about something real quick in equities that is kind of important, I think, today. We have a bearish engulfing pattern where the S&P made new contract highs last night and took out yesterday's lows just now as I'm speaking and set up what's called a bearish engulfing pattern. Major outside key reversal to all the old technical analysts. Looking at the candlestick studies, actually a gentleman on Twitter, Mr. Khan, thank you very much if you're watching my video. I appreciate your help. Pointed me to a website that did an analysis on all these different candlestick signals. Bulkowski's blog. Google it, guys. It looks like I'm going to have to spend some time in there. It looks like a pretty neat tool. Talked about bearish engulfing patterns in bull moves, like we're seeing right now. Very good short-term trading signal. Not a lasting signal, though. Not something that had any efficacy for the long-term picture. Like, Elliott Wave right now is looking for a top, some type of a top, and what looks like to me a third wave higher in the equity markets. So I'm looking for some type of fourth wave correction here. Third waves are notoriously powerful. Third waves often extend and go beyond 5 waves. They'll go into 7 waves or 9 waves. And equities do that anyway. Not just third waves in equities. Equities, we see that a lot, especially if you look at like short-term wave counts, which personally I don't think they work that well in equities, or at least I haven't been able to utilize them that well in equities. Big picture, I think they work okay. So many Elliott Wave analysts have caught this bull move. They've been labeling this a third wave rally and an ongoing bull move for quite a while. Mr. Prechter and his minions have been wrong and haven't been able to turn around and come up with a new wave count, which they should have done a long time ago. And it gives many Elliott Wave analysts a bad name. Go look up Tony Caldaro, Caldaro, on the internet. Tony is one of the better Elliott Wave analysts in the equity markets around. You can learn a lot from reading Tony's blog too. Man, look at that, 2 blogs for you guys to look at. I used to be a teacher, right? If you don't learn something new every day, you're falling behind the curve. And what did we learn today? Yesterday we looked at the treasuries putting up the minor bearish reversal signals. The hammers, the hanging mans, whatever you want to look at and call it that. I said those are minor trend change indicators. All they are looking for is a minimum lower low. Well, they did the lower low last night. We took out the 133.11 level. I think it went down to 133.09 and reversed. And by the time I woke up, we were trading 133.14 or 15 again this morning. And then the data came out this morning and it was off to the races. I tried to short some resistance areas, gave a few ticks back, and didn't really recover from that little mind-messing move there. That's still a big problem with me. Once I get the first move wrong, trying to come back and reassess, I got to work on that one. All right, many things to work on. Back forward now. New highs in bonds and notes. The bonds have actually come back off this afternoon and overlapped the previous highs, which kind of tells me the market is probably going to be in a big corrective pattern up here, at least through tomorrow. I don't think the ECB is going to be that important for the U.S. Treasury market. Today's economic data was important. Tomorrow's jobless claims data will be important. And obviously Friday's non-farm payroll will be the granddaddy. A lot of people have revised their estimates lower today after we saw the ISM data. QE doesn't help the employment situation. QE helps the equity markets. QE helps the bond markets. And if you're not in the vast minority of Americans who don't have money, or am I saying that right? No. If you're not in the vast majority of Americans who don't have money in the equity markets or in the bond markets, QE doesn't do anything for you. So move on. All right, sorry about that. We're having a little issue here with the recording. Moving on. Tonight, if we do get any kind of a dip, which I think is likely going into the ECB meeting tomorrow, we could see the 133.15, 15 plus level in the 10-year. I'd like to see if the bonds can take a look at that 148.25 to 148.28 area. I think those are good areas where you could probably put a scalp buy on. Don't look for new highs tomorrow, or if we do, they might be minor. I wouldn't be surprised to see a retest of the highs overnight or into tomorrow morning very early. The London hedge fund guys are pretty long. They've lightened up over the last couple days. I think they added back some longs today. I'll be interested to see what open interest has done. We saw pretty big drops in open interest the last 2 days, telling me they got out of longs, and now this move is going to force them right back into longs when the market made new highs. So they'll be buying tomorrow morning. If you do get a dip tonight, it'll probably be, before that 2 a.m. London opening, it'd be my guess. Might be out of Asia. I think China comes back tonight. We do get a buyback tomorrow. We do not have a buyback Friday. Didn't matter today. The market was rallying off that ISM data and never looked back. So either way. Okay, game plan set. Let's hope for the dip. We can get some longs back in and see what happens from there. Have a great night, guys. We'll see you tomorrow morning.